I want to welcome back Andy Schectman to walk us through the headlines as the nation descends further into chaos. Welcome back, Andy.
Elliot, good to see you, buddy. Yes, it does. It does descend further and further into chaos. No question about it. It's the old Chinese curse. May you live in interesting times. These are certainly interesting. Anything but dull and complacent. That's for sure.
Exactly. It's funny. I love the title of the show because it sounds dramatic, but every week it just feels more and more appropriate. So
I agree. Definitely. Speaking of chaos, the S&P 500 has experienced its worst 17 days to start a year in history. So when you talk about chaos, there's so many places to point, but when you start to see things like this happening, it will start to creep into the ethos, into the periphery, if you will, of the mainstream. That'll be too hard to ignore. Just the alternative media like us been focusing on this for a long time, but I think we're getting to that point where people on a larger scale are beginning to wake up, I think, to what's happening.
absolutely. Absolutely. And so the first headline I want to get to, which speaks a lot about the times we're living in, debt up $2 trillion in year one of Biden.
Yeah, well, when you print more money, it means that more dollars are chasing the same amount of goods and services. And this is what causes prices to rise. And like you were saying, in just the past 3 fiscal years, the federal spending is up $7 trillion a year, up from $4.4 trillion in 2019. These numbers are ridiculous. And I think if you want to kind of put this into perspective, we talk about, have been for a while now, that 50% of every dollar has been printed in the past 24 months, but that's actually changed. And in reading recently, since January 2020, the United States, and that number of dollars in circulation is up to $20.35 trillion. 80% of every dollar in circulation, in existence, every one, has been printed since January 2020. This isn't a conspiracy. This is according to the Board of Governors of the Federal Reserve System. And so when you talk about inflation, inflation is not rising prices. Inflation is more money being created, and rising prices are a symptom of inflation. And I really do believe that no matter what the Fed says, they're going to make a few token rate hikes. Maybe see one here today with the FOMC meeting, but they can't do anything substantive, because if they do, Elliot, the whole system crumbles. And so I think they will sacrifice the dollar, and inflation is here to stay. I think this is just the very beginning. These rate hikes that they will implement, these quarter or half point token hikes, will give them a little bit of latitude, so that when the shit really does hit the fan, to whatever degree, they will be able to reverse course and not bring the world reserve currency nominally negative, which is really the good thing.
Exactly. So the scare here, and the reason the stock market was crashing, was because the Fed is at risk of tightening policy into a slowing economy, which is never a good situation. So do you foresee them maybe doing a quarter point, everything collapsing, and then reversing course immediately?
And not a quarter. I don't think a quarter point will do that, but a couple of rate hikes would start to, just like we saw in 2018. And, when they got the 10-year Treasury upwards ends of 3%, things started to collapse. And, when you talk about what they're talking about doing, they're talking about bringing it up to 2%, right? From a federal funds rate of 0. That's a pretty big rate hike. There's your 4 rate hikes a year at a quarter point. But that's, if you think about it, what is that? That's spitting in the ocean. When you have inflation by the CPI at 7%, which ignores food, energy, and housing, the real CPI closer to 15%, and you raise rates to 2%, even using those measurements, you're still negative 5% real term. And so it doesn't do anything. And we've reached that point in the game where they can do all they want in terms of talking and the rhetoric. And that's what I think a lot of this is. The only way to get serious, Elliot, would be to raise rates to 7.5% above the federal funds rate, above the stated CPI number. That's the only way that you actually do something real about inflation. And that's what Paul Volcker did in 1980. And I think anything short of that really is just jawboning and pandering to people who are becoming, I think, freaked out about inflation. But in the end, I think you would find a far greater panic when the markets collapse, and not just the stock market, but the real estate and ultimately the bond market, mother of all bubbles too. They cannot let rates rise substantively enough to where you see this domino effect of markets cascading. But they have to, I think, placate the masses who are, you turn on the news and you see inflation. It's kind of hard to ignore. Well, look, the Fed lies to us. They told us in 2008 the subprime crisis was contained. It wasn't. And they told us that inflation was transitory. We knew it wasn't. It's structural. It's here to stay. Just about everything they tell us, we can expect the opposite. When they tell us they're going to get tough on inflation and raise rates, they'll do it for a little bit. This is why you haven't seen the 30-year or even the 10-year really move too much. What you're seeing is the 1 and the 2-year markets move, because the bond traders know that the Fed will try to get tough on inflation here for a little bit, freak markets out so much that they start to convulse. And that's when they will reverse course and probably stimulate 2.0 much greater than they've been doing already.
Yeah. And it's just stunning to me, though, because how can they keep like mortgage rates at 3% when inflation's 7 or 8 or 9%? Like, what doesn't that mean that assets in general just have to keep spiking because they're pretty much given away for free?
That's the problem here, is that price discovery has become impossible in this illusionary environment. When I bought my house here, that I moved out of Minnesota into, see my pillow back there, from Minneapolis to Florida, I contemplated with not taking out a mortgage. I did well enough on my home where I was going to just put the proceeds into a home. And I thought about it, why would I do that when I can get a mortgage at 3% and inflation is running 2.5 times that? It's free money. And this is why you have such a difficulty in price discovery. I mean, precious metals have no price discovery at all. Real estate's price discovery is people just believe that their house will go up indefinitely. But, the first home that I bought in 1994, interest rates were 8 7/8. Can you only imagine what 9% interest rates would do to this market? It would decimate it. And so when you talk about what the Fed has done, here's your K-shaped recovery. And they talk about K-shaped environment, let's say, where the wealthy are the top end of the K. They have assets. And if you have real estate, you've done incredibly well. If you have stocks, you've done incredibly well. If you have bonds, you've done incredibly well. Assets feed you, liabilities eat you. The bottom end of the K is the increasing cost of living for everyone who has no assets. They're going down. Harder to put food on the table, harder to drive to work, harder to heat your home. These are rising costs that are associated with massive Fed stimulus and low interest rates that have enriched the wealthy and have impoverished the lower class and really begun to eviscerate the middle class. So this is a bad situation, but you don't see the uproar from the wealthy because their assets have never been worth more. And so you have to get tough on inflation, at least talk about it to placate the masses. But in the end, I think that, be careful what you wish for. They are damned if they do and damned if they don't. I just have a hard time believing to the level that these markets have been inflated, to the distortion in price discovery. We've talked about the phenomenon before, Elliot, in Austrian economics. It's called the crack up boom, where after a massive expansion in credit, the misallocation of resources and capital create impossibility in price discovery. And that's exactly what this is. I live in an amazing golf community in southern Florida. I'm talking with a lot of the members who have become friends of mine over the last 9 months. They told me 4 years ago you couldn't give houses away in this neighborhood. And now they've been doubling every year, literally. Since I moved here, the cost of a membership at this country club, the initiation is up 40% in 9 months. Prices just keep going up and up and up and up. And this is exactly what Ludwig von Mises described as the crack up boom, where these misallocations of resources and capital create an environment where you really can't find real price discovery. So let's talk about that in terms of what the Fed is doing. Now, they said they want to raise rates 2%, up to 2% within the next 2 years. So, and as we talked about it probably last week, a 1% rise in interest rates often calculates with a 10% decrease in housing prices. So a guy like me who moved in 9 months ago, in 2 years, I'm underwater in comparison to, well, if things play out the way that they typically do. So, you have a lot of negative equity out there, people who bought houses at high values. So where is real price discovery? What is fair value any longer? It's difficult to ascertain, but this is the problem the Feds have to deal with. And look, if inflation stays hot, there is no way the Fed can easily back off, because we are in the midst of an everything bubble, and it will burst. And it's the bursting of this everything bubble, spreading from bonds to stocks and real estate, that I think will very quickly make the Fed reverse course and change what their mantra and go back to an accommodative stance and easy money. And because if not, it's going to be the greatest depression of all time.
Absolutely. And that's kind of the thought process. People get disenamored with risk tech assets, and they move to safer haven assets like gold. And so far this year, gold's actually been outperforming because everything has been crashing, including tech. And here's just an interesting headline saying big tech is rattled because there seems to be bipartisan support for antitrust regulations on FANG stocks, which is pretty much leading everything higher. So that's just one indication that this stuff could be vulnerable.
Oh, absolutely. You have markets that have become so distorted, unabated, that it is creating. I mean, if you pull those stocks out of the market, most of the stocks are down considerably. Now, those stocks have led the market higher, and it's a dangerous situation where you have an illusion of market strength led by a handful of gigantic stocks that not only are driving the market, but in many respects driving the rhetoric of this country. And you've been around alternative media as I have for the past couple of years. You see the impact that these large media or these large tech companies have, and the ability to censor information, freedom of speech, and the role that they're playing. I think I'm typically not for government intervention and regulation, but this is an area where I might be easily convinced, simply because of the issues that they're creating. And you talk about too big to fail banks. Well, this is maybe even worse, where you have these companies out there who have convinced the world that they're too big to fail and too big to be regulated, but they really ought to be, based upon just the amount of censorship that we've seen in the past 2 years. And, centered around elections, centered around vaccines, centered around just the information that we get is being filtered through a handful of sources. Every magazine, every television station, every radio station, every newspaper on the planet, in conjunction with these big media companies or these big tech companies, is owned by 4 companies. So it's a filtering of the information through a handful of companies. I think that a little bit of regulation would be a darn good thing, however it plays out in that space.
Yeah, especially it's crazy because AWS, Amazon Web Services, pretty much owns like the internet, and they can pull whatever they want off of it. So I'm with you on that. But given these headwinds, the fear in the market, people eventually will be disenamored with this stuff. We are seeing flows into gold. So SPDR Gold Shares, the largest bullion-backed exchange-traded fund on Friday, recorded its biggest net inflow since listing in 2004. So that's like 16 years ago or so. we're talking real big interest in gold. What is your take on that?
Yeah, well, you're beginning to see a lot of money move into gold, not only and silver, but not only through the investing public. We're at a 31-year record for central bank holdings. I think last year they purchased over 4,500 tons more precious metals. So you have the biggest money in the world starting at the central banks, and they've been doing this really since 2017. You got the commercial banks loading up on it. You have the family offices and the sovereign wealth funds, as we've talked about this group on COMEX titled the Others. These are the big money managers that fall into, we believe, into category of sovereign wealth funds, gobbling it up. And now you're seeing massive inflows into the world's ETFs, which is pretty interesting. And and so you get a lot of people when you look at this bullish configuration. And a lot of people are wondering why the prices of gold and silver aren't skyrocketing in the face of, concrete proof of demand. You can see it. Overwhelming, I would argue, the supply, both on a retail basis and a wholesale basis. And again, laws of supply and demand in terms of Econ 101, they left out in the curriculum the chapter dealing with COMEX manipulation. And you have massive manipulation on COMEX holding down the price. Bank of America right now is short 800 million ounces of silver and somewhere in the neighborhood of 20 million ounces of gold. And why are they doing this? Who are they doing it on behalf of? Is it on behalf of the government? Are they trying to kill the canary in the mine shaft? Don't know. But I will tell you that at some point, especially with the massive amount of silver that's gone into SLV and other silver ETFs, where's it going to come from? We're running out of silver. It's depleting in nature. You have massive industrial components. And when you talk about silver in particular, the duality of this demand, industrially and monetarily, it's an environment where you continue to see these monetary inflows. Where does it come from? It will create, it's setting the stage on top of an 850 million ounce short position by Bank of America. You're talking gasoline on a 4-alarm fire. At some point, whenever that point is, when you have global demand overwhelming the ability of the U.S. government to hold back the price, I don't know. I think it's setting the stage for some amazing fireworks. And so, yeah, I think that the inflows into the ETFs are certainly emblematic of people waking up to, the value you find in precious metals, but also the market conditions. And it's time to feather the brakes a little bit and realize that return on your money is great, but return of it is, in this environment, might be a little bit more poignant.
Absolutely. So just to close out here, you're the CEO of Miles Franklin, selling precious metals. Do you want to give people some insights into how they can get access to it?
Yeah, absolutely. And I think when I think of owning precious metals too, Elliot, to me, it's my wealth, it's money. And when I realized, I just read an article that over almost 2,500 bank branches have closed 2021, almost tells me like they're waiting for some sort of an event, a bank run or a cashless society. Getting out of harm's way and putting your money into historical wealth that's lived through every pandemic and German hyperinflation and the Great Depression and every war is really important right now. All they need to do is to send an email to us, reference the early stage investor in the subject line, and email to info@milesfranklin.com, info@milesfranklin.com. If it's important to speak with me, please forward this to Andy, and I will personally answer the email. We will send you a current price list inventory. We'll make sure we get you the best price in the United States as compared to all the major wholesalers or retailers. And we have started. It's about 80% completed, our new website. In the meantime, we're still old school. We prefer to be old school, kind of analog in a digital world. In a world where, we talked about before, 11 countries from around the world get together and talk about a global hack or some sort of a global threat related to, say, a hacking of the financial system, where when Powell is asked what is the biggest threat to the U.S. financial system, a cyber threat, he says, a global cyber threat. I think being old school is not a bad idea. And so give us a call at 800-822-8080 or send an email to info@milesfranklin. You'll get a current inventory. You'll get your questions answered. You'll get a phone call from one of our brokers. We'll make sure that you get the very best price in the United States from a company, maybe the only licensed and bonded company in the United States, major company in the United States, from a company that's never had a customer complaint, one of only 24 U.S. Mint authorized resellers in the world. We'll make sure, damn sure, it's a good experience and that your listeners won't be our first complaint. But look, I don't think it's ever been more important, Elliot. I really don't. And I sent you the list of a couple of specials that we're running this week that you can post. Premiums are getting higher. Products getting much harder to come by, way harder. The most difficult I've had it in 31 years. So now's a good time to dip your toe, and we'd love the opportunity to work with your listeners and answer their questions and give them a good experience.
Perfect. Well, thank you so much for the insight. Appreciate it.
Yeah, absolutely. And I guess I'll just leave it one last thing.
Yep.
And that is, if I were going to give anyone some advice, I would say, inflation's here to stay. The central planners since the beginning of time, back to the Roman era, when they clipped the edges of coins that were silver, they will always choose inflation over austerity. They will always choose inflation over the tough decisions. They will not sacrifice the markets, the bond market, the real estate market, stock market, and impoverish literally everyone in this country and create a massive depression. So instead, what they're going to do is they're going to choose inflation. And I will say this to you, it is a gigantic tax on everyone, and it will impoverish an entire generation, Elliot. It will, unless people put their money into real assets, things that can't be printed. Because if you own paper and only paper or digital assets, you're going to get wiped out. And you can see that by the fact that literally since January 2020, 80% of every dollar in circulation, 80% has been printed since January. This is the road to hyperinflation, to Weimar Republic. And so you have a government that's understating the inflation levels massively. And they're not going to stop. And the jawboning about getting tough on inflation, well, may be true for one or two rate hikes, and then watch what happens. They'll reverse course and do all they can to go right back to where they were, and then some, because it's the only path. It's either inflate or default, really, is pretty much the answer. So this is why we own precious metals, Elliot, and I really appreciate the opportunity to be here with you every Wednesday and to chat about this. And I hope I'm wrong. I got 3 young kids. I hope I'm wrong, but I don't think I am. And this shirt, triple digit silver, courtesy of Keith Newmeyer, who sent this to me for the holidays, that's real. It's really real. I think you'll see that. All you need to do is realize that the average price between gold and silver for the past 150 years has been 42 to 1. Take the current price right now of 1850, call it, and divide it by 42, and you get $44. But take the price of 1850 and divide it by 7, which is what it's coming out of the ground at globally and has been for 2 years, you get $265. To say silver could be $265 tomorrow, it's not unrealistic. In fact, it's doing nothing other than mimicking the geologic ratio between the two. So hashtag you ain't seen anything yet. I appreciate being here, Elliot. I appreciate our candid conversations, and I look forward to seeing you next Wednesday, doing the same thing all over again.
This discussion is for informational purposes only. Please consult a certified financial planner when making any decisions about investing. And do your own research before making any decisions. Investments are risky, and you can lose lots of money in them.